What's up, future millionaires? It's Infinite Income Lab, and let's talk about building wealth. You ever feel like investing is this exclusive club for folks with yachts and private jets? Newsflash, it's not. You don't need a trust fund to grow serious wealth. Even starting with just $100, you can hit $10,000 if you play your cards right. Skeptical? I was too, until I learned the ropes. Stick with me, and I'll break down how to make your money work as hard as you do. First things first, we gotta pick where to put our cash. Now, this might seem like a daunting task, especially if you're new to the world of investing. But don't worry, we're gonna break it down step by step. The key is to start with a solid foundation and build from there. So let's dive in and explore the basics of index funds. Now, I'm not gonna lie, the investment world can seem like a jungle out there, right? With all the noise and chaos, it's easy to feel overwhelmed. You see traders shouting on the floor, screens flashing with endless data, and it feels like you need a PhD just to understand what's going on. But here's the thing, you don't need to be an expert to get started. Hedge funds, derivatives, crypto, it's enough to make your head spin. These are complex financial instruments that even seasoned investors sometimes struggle with. But for beginners, it's best to steer clear of these and focus on something more straightforward and less risky. That's where index funds come in. But here's the good news. You don't need to be Warren Buffett to start investing. You don't need to spend hours analyzing financial statements or predicting market trends. In fact, some of the most successful investors advocate for a simple hands-off approach. Warren Buffett himself has recommended index funds for most people. When you're just starting out, keep it simple. The simpler your investment strategy, the easier it is to stick with it. And consistency is key in investing. You don't need to chase the latest hot stock or try to time the market. Instead, focus on building a diversified portfolio that can grow steadily over time. And for me, simple means index funds. These are funds that track a specific market index like the S&P 500. They offer a way to invest in a broad range of companies without having to pick individual stocks. This makes them an ideal choice for beginners who want to get their feet wet in the investment world. Think of an index fund like a basket of stocks. Instead of putting all your eggs in one basket, you're spreading them out across many different companies. This diversification helps to reduce risk, because if one company doesn't perform well, it won't have a huge impact on your overall investment. Instead of betting on one single company, you're investing in a whole bunch like the S&P 500. This index includes 500 of the largest companies in the US, giving you exposure to a wide range of industries and sectors. It's like having a little piece of the entire market. This spreads out your risk, which is crucial when you're starting with a smaller amount. Diversification is one of the fundamental principles of investing. By spreading your investments across different assets, you can protect yourself from significant losses. It's a way to balance risk and reward. Plus, index funds have super low fees, meaning more of your money is actually working for you. High fees can eat into your returns over time, so it's important to keep costs low. Index funds are known for their low expense ratios, making them a cost-effective option for long-term investors. Remember, we're playing the long game here, people. Investing is not about getting rich quick. It's about building wealth over time. Patience and discipline are your best friends in this journey. By starting with index funds, you're setting yourself up for steady, long-term growth. So take a deep breath, stay the course, and watch your investments grow. Okay, so we've got our index fund picked out, but how much should you actually be investing? This is a question that often stumps many new investors. The truth is, the amount you start with isn't as important as the consistency of your investments. You don't need to have a large sum of money to begin your investment journey. In fact, starting small can be incredibly beneficial. Now, I know what you're thinking. Amanda, I'm working with $100 here, not $10,000. And that's a valid concern. Many people believe that investing is only for the wealthy, but that's simply not true. You can start with whatever amount you have, even if it's just a small sum, and that's totally fine. This is where the magic of dollar cost averaging comes in. Dollar cost averaging is a strategy that allows you to invest a fixed amount of money at regular intervals, regardless of the market conditions. This means you don't have to worry about timing the market perfectly. Instead of trying to time the market and dumping all your money in at once, you invest small amounts consistently over time. This approach helps to mitigate the risk of market volatility and ensures that you're buying shares at different price points. We're talking like $10 a week. It might not seem like much, but those small amounts can add up over time. The key is to be consistent and disciplined with your investments. That's it, less than a Netflix subscription. Think about it. If you can afford to pay for a streaming service, you can afford to invest in your future. It's all about prioritizing your financial goals and making small sacrifices today for a better tomorrow. Now, you might be thinking $10 a week, that's going to take forever. But here's the thing, investing is a marathon, not a sprint. The goal is to build wealth over time, not to get rich quick. Patience and consistency are your best friends in this journey. But here's the thing, when you dollar cost average, you're buying more shares when the price is low and fewer shares when the price is high. This helps to smooth out the highs and lows of the market, making your investment less susceptible to short-term fluctuations. It's like buying your favorite sneakers on sale. You wouldn't want to pay full price if you know you can get them cheaper later, right? The same principle applies to investing. By spreading out your investments, you can take advantage of lower prices and get more value for your money. Over time, this strategy can actually lower your average cost per share and maximize your returns. It's a simple yet effective way to build your investment portfolio without the stress of trying to predict market movements. Plus, it takes the emotion out of investing, which is huge. Emotional decisions can often lead to poor investment choices. By sticking to a consistent plan, you can avoid the pitfalls of emotional investing and stay focused on your long-term goals. No more stressing about market crashes or trying to predict the next big thing. The market will always have its ups and downs, but with a consistent investment strategy, you can ride out the waves and stay on course. Just set it and forget it. Automate your investments so you don't have to think about it. This way, you can focus on other aspects of your life while your money works for you in the background. Consistency truly is the key to successful investing. Now let's talk about the real game-changer compound interest. This concept is often referred to as the cornerstone of wealth-building strategies. It's not just a financial term, it's a powerful tool that can transform your financial future if you understand and utilize it correctly. Einstein called it the eighth wonder of the world, and for good reason. He famously said, "He who understands it earns it, he who doesn't pays it." This highlights the dual nature of compound interest. It can work for you or against you, depending on how you use it. Compound interest is basically your money making money, and then that money making even more money. Imagine a snowball rolling down a hill, gathering more snow and growing larger as it goes. This is how your wealth can grow over time with compound interest. It's like a snowball effect for your wealth. The initial amount you invest starts to earn interest, and then that interest starts to earn interest as well. Over time, this can lead to exponential growth in your investments. Let me give you an example. Suppose you decide to invest a small amount of money regularly. This doesn't have to be a large sum. Even modest, consistent investments can grow significantly over time. Let's say you invest just $100 a month, which is totally doable, right? This might seem like a small amount, but the key is consistency and time. And let's assume an average annual return of 10%. This is a reasonable assumption based on historical stock market returns, though actual returns can vary. Now, I know past performance isn't indicative of future results, but stick with me. The idea here is to illustrate the potential power of compound interest over time. Over 10 years, with the power of compound interest, you could end up with over $10,000. This is the result of your initial investments growing, and the interest on those investments also growing. That's the magic of letting your money work for you over the long term. The longer you leave your money invested, the more it can grow. The earlier you start, the more time your money has to grow exponentially. Time is one of the most critical factors in the equation of compound interest. So even if you're starting small, don't underestimate the power of compound interest. Every little bit counts, and the sooner you start, the better. It's like planting a seed and watching it grow into a giant money tree. Just as a tree takes time to grow, so does your investment. But with patience and consistency, the results can be truly remarkable. Educating yourself about compound interest and other financial principles is crucial. The more you know, the better decisions you can make about your money. Setting clear financial goals and creating a plan to achieve them can help you stay on track. Whether it's saving for retirement, a down payment on a house, or a child's education, compound interest can help you reach your goals faster. Regularly reviewing your investment portfolio and making adjustments as needed is also important. This ensures that your investments are aligned with your goals and risk tolerance. Ultimately, The power of compound interest can lead to financial freedom and security. By making smart investment choices and being patient, you can watch your money grow and achieve your financial dreams. Listen, building wealth isn't about luck. It's about taking control of your financial future, one smart decision at a time. You don't need to be a Wall Street whiz or have a ton of cash to get started. Remember, time in the market beats timing the market. The sooner you start, the more time your money has to grow. So what are you waiting for? Take that first step today, even if it's just investing $10. Your future self will thank you.